In just a few hours, the Federal Reserve is expected to announce it's cutting interest rates, and that phrase alone is sending ripples through the economy. The decision, which drops today, is one of the most anticipated of the year. For a lot of people, it's just confusing financial news, a headline filled with jargon that feels totally disconnected from daily life. But if you understand what's actually happening, it can be a huge opportunity. In fact, it's one of the most important signals the government sends about where your money could be headed next. In the next few minutes, we're going to break down in simple terms what this expected move really means for your stocks, your savings account, and even your chances of buying a home. No complex jargon, no confusing charts, I promise. This is just the straightforward information you need to make smarter money moves. We'll cover what a rate cut is, why it's likely happening now, and most importantly, give you an actionable playbook for your own portfolio. Think of this not just as news, but as a financial roadmap. And speaking of the news, I'll be streaming the official announcement live right here on this channel today at 3:30 p.m. Eastern, so you can watch it unfold with me. First things first, what does it even mean when we say the Fed is cutting rates? Imagine the Federal Reserve is like the master thermostat for the US economy. Its job is to keep the economic temperature just right, not too hot, which causes runaway inflation, and not too cold, which leads to a recession and job losses. The main dial on this thermostat is called the federal funds rate. Now, you and I don't use this rate directly. It's the interest rate big banks charge each other for overnight loans, but that rate kicks off a massive chain reaction. When the Fed turns the dial down, it gets cheaper for banks to borrow money, and when it's cheaper for them, they make it cheaper for everyone else. It's like the wholesale price of money goes down, so the retail price for you also gets lower. This affects everything from your credit card's APR to the loan a business takes out to build a new factory. So, a rate cut is really just the Fed deciding to make money cheaper to borrow, hoping to heat things up and encourage growth. So, why are they likely doing it now? The Federal Reserve has a two-part mission: keep prices stable, manage inflation, and aim for maximum employment, keep the economy strong. Today's decision is tricky because those two goals are pulling in opposite directions. According to reports from journalists like Nick Timiraos, who is well known for his Fed coverage, there are deep divisions inside the central bank. On one side, some officials are worried about a vulnerable job market. They see signs that businesses are struggling and unemployment is rising and believe it's time to cut rates to keep the economy from slowing down too much. On the other side, some officials fear that cutting rates now could cause inflation to flare back up. After a long fight to get prices under control, they are worried about easing up too soon. This has left Fed Chair Jerome Powell with the difficult task of building a consensus. He is reportedly aiming for a quarter-point cut, but because of the deep disagreements, we might see some soft dissents, where a few officials publicly vote against the decision. In simple terms, the Fed is trying to take its foot off the brake before the car comes to a complete stop, but not everyone agrees it's the right time. But what would all this high level economic maneuvering actually mean for your wallet and your investments? Let's get into it. This is where the rubber meets the road. A potential rate cut isn't just an abstract number. It would directly hit four key areas of your financial life: your stocks, your bonds, your savings and debt, and real estate. Let's walk through each one. Part one: the impact on your stocks. If the Fed cuts interest rates today, the stock market will be paying close attention. For investors, it's critical to understand why. There are two big forces at work. First, lower interest rates can act like a shot of adrenaline for corporate growth. From a business's point of view, if a company wants to build a new factory or develop new software, it almost always borrows money to do it. When interest rates are lower, that debt costs less. This means more projects become profitable, and companies are more likely to invest in growth, which can lead to higher profits and hopefully a higher stock price. Second, and this is a key concept, is the idea of competition for your money. When interest rates are high, safe investments like high yield savings accounts offer great returns. Why risk your money in the stock market for a potential 8% return when you can get a guaranteed 5% in cash? But when the Fed cuts rates, the return on those safe investments drops. That 5% savings account might now only offer 3.5% or 4%. Suddenly, the stock market looks a lot more appealing in comparison. This can cause a big shift in attitude, what Wall Street calls a risk-on environment. Money can flow out of cash and into stocks, pushing prices up. So, which stocks tend to benefit most? Historically, the big winners in a rate cut environment are growth stocks. These are companies in sectors like technology and consumer discretionary. Think software companies, e commerce giants, and businesses that sell non essentials. The reason is simple. These companies often rely on borrowing to fund their rapid expansion, so lower rates directly help their bottom line. Plus, a growth stock's value is based heavily on its expected earnings far into the future. When analysts calculate the value of those future earnings today, a lower interest rate makes them more valuable, giving their stock prices a powerful tailwind. On the other hand, defensive sectors like utilities and consumer staples, companies selling things we need no matter what, like electricity and toothpaste, may not see the same dramatic boost. Their performance isn't as tied to economic cycles. So, what's the playbook for stocks? The first rule is don't make rash decisions. The market is forward looking and has likely priced in an expected rate cut. You may have seen stocks rally in the weeks leading up to today's announcement. This isn't the time to suddenly go all in on a few trendy tech stocks. It's a time to review your strategy. Does your portfolio have enough exposure to growth? If you've been sitting on a lot of cash because savings rates were so high, a rate cut is a clear signal that it might be time to start strategically moving that capital back into your long-term diversified investment plan. Bonds are often seen as the boring part of a portfolio, but in a rate cut world, they can get surprisingly exciting. The relationship between interest rates and bond prices is one of the most fundamental ideas in investing, and it works like a seesaw. When interest rates fall, the price of existing bonds goes up. Here's an analogy. Imagine you bought a $1,000 bond last year that pays you 5% interest, or $50 a year. Now, if the Fed cuts rates, new bonds being issued today might only pay 3% or $30 a year. Your old bond, which still pays that higher 5%, suddenly looks incredibly attractive. If you wanted to sell it, another investor would be willing to pay you more than the $1,000 you originally paid because its interest payments are so much better than what's available on the market. That increase in price is your bond's value rising. How much a bond's price changes with interest rates is known as its duration. Simply put, bonds with a longer time until they mature, like a 10-year or 30-year bond, have a longer duration and are much more sensitive to rate changes. Their prices will jump more when rates are cut, but they also carry more risk if rates were to rise again unexpectedly. For many investors, the sweet spot is often in intermediate term bonds with maturities in the 3 to 7-year range. They offer a good balance, benefiting from falling rates without the extreme volatility of long-term bonds. So what's the strategy for bonds? For the last couple of years, many people have focused on very short-term bonds to get high yields with low risk. A rate cut signals a potential shift. As rates fall, the yields on those short-term investments will drop fast. This might be a good time to consider adding some duration to your portfolio with intermediate term bonds. This not only helps you lock in a relatively higher yield for longer, but also gives you the potential for price appreciation as rates fall. We're about to dive into how all of this affects your savings, your debt, and the housing market, areas where many people will feel the impact the most. If this breakdown is helping you understand these shifts and you're ready to take control of your financial future, make sure to check out my macro investing masterclass in the description. It's designed to give you the tools and insights to navigate these changes confidently. And don't forget to hit that subscribe button. We release videos like this every week to help you make smarter financial decisions and build wealth. This is where a Fed rate cut is a real double-edged sword with both good and bad news for your bank account. Let's start with the bad news. Your savings account is about to get less rewarding. For the past couple of years, savers were in a golden era. High-yield savings accounts, YSAs, and CDs were offering fantastic rates, sometimes over 5%. It was a great risk-free way to earn a solid return on your emergency fund. Unfortunately, if a cut happens, those days are likely coming to an end. The interest rates on savings products are directly tied to the federal funds rate. When the Fed cuts its rate, banks quickly lower the APY they offer on savings accounts. A quarter point cut from the Fed will likely mean a quarter point drop in your HYSA rate within weeks. Now, for the good news, the cost of borrowing money is also set to go down. If you have variable rate debt, a rate cut is your best friend. The best example is credit card debt. Credit card APRs are almost always tied to the prime rate, which moves with the Fed's rate. A rate cut means the interest on your balance will start to decrease, making it easier to pay off. The same goes for other loans. If you're looking to get a personal loan or a car loan, you'll probably find more attractive rates after a cut. It's also a golden opportunity to refinance. If you have high interest debt, this could be the perfect time to consolidate or refinance into a new loan with a lower payment. So what's the actionable strategy here? For your savings, don't panic. The main job of your emergency fund is safety and liquidity, not high returns. But a rate cut is a wake up call to check if you have too much cash on the sidelines. If you have money saved for long term goals like retirement in 20 years, sitting in a savings account where returns are about to fall, you're losing purchasing power to inflation. This is the time to revisit your investment plan. For your debt, be proactive. If you have high interest credit card debt, a rate cut gives you a helping hand. This is the time to double down on your payment plan. For other loans, start shopping around. Check refinancing options. The savings from a lower interest rate can be huge over the life of a loan. For anyone dreaming of buying a home, the words Fed rate cut often sound like a beacon of hope, and for good reason, though the reality is a bit more complicated. First, let's be clear. The Federal Reserve doesn't set mortgage rates. However, its decisions heavily influence them. A 30-year fixed mortgage rate tends to follow the yield on the 10-year Treasury bond. When the Fed cuts rates, it sends a signal about the economy that usually pushes down that 10-year yield, and mortgage rates tend to follow. This has a huge impact on affordability. A lower mortgage rate means a lower monthly payment, which can save you tens of thousands of dollars over the life of a loan. For instance, a 1% drop in mortgage rates can boost a buyer's purchasing power by almost 10%. This could mean you can finally afford a home in a neighborhood that was out of reach, or just have more breathing room in your budget. But here's the catch-22 that every potential homebuyer needs to understand. You aren't the only one who knows rates might be falling. Lower mortgage rates could draw tons of other hopeful buyers back into the market. This surge in demand can create a fiercely competitive environment. Suddenly, you could find yourself in bidding wars, which can drive prices right back up. So the money you save on a lower interest rate might get eaten up by a higher home price. So what's the strategy for navigating the housing market? First, if you're serious about buying, a potential rate cut is your cue to get all your financial ducks in a row. Get pre-approved for a mortgage so you know exactly what you can afford and can act fast. Lenders are already pricing in these potential cuts, so the rates you see today likely reflect this new reality. Second, be ready for competition. This probably isn't the time for lowball offers. You need to be a strong, decisive buyer. Third, focus on the long game. Don't get so caught up in timing the absolute bottom of interest rates that you miss a good opportunity. A lower rate is great, but finding the right home at a price you can comfortably afford is what really matters. All right, that was a lot, so let's boil it down to a quick summary of what to do if the Fed cuts rates today. First, for stocks. A rate cut is generally a good thing, especially for growth sectors like tech. It's a good time to check if you're holding too much idle cash. Second, for bonds. Remember the seesaw. As rates fall, existing bond prices rise. This is a moment when a safe asset can also be a source of growth. Third, for savings and debt. Expect your savings account APY to drop. But on the flip side, it's a prime time to attack high interest debt or refinance. Fourth, for real estate. Mortgage rates will likely head lower, which helps affordability, but brace yourself for more competition from other buyers. Now, a crucial word of caution. The single biggest mistake an investor can make is to overreact to the news. Smart investing is a marathon, not a sprint. A Fed rate cut changes the financial landscape, but it doesn't change the fundamental principles of building wealth. Your strategy should always be rooted in your personal goals, your time horizon, and your risk tolerance. This news should inform your strategy, not blow it up. So what's the bottom line? A Fed rate cut is like a shift in the economic weather. It changes the conditions, making some paths easier and others more challenging. It makes saving in cash less attractive, while making borrowing and investing in growth assets more appealing. For the everyday investor, the message isn't to panic or chase a hot trend. The message is to be aware. Understand that the 5% you were earning risk-free in a savings account might be going away, and that money needs a new job. Understand that borrowing costs are getting cheaper, offering a chance to clean up your finances, and understand that assets like stocks and real estate are likely to get a boost, but that may come with more competition. This is a moment to be proactive, not reactive. It's a time to look at your financial plan with fresh eyes and make the small, smart adjustments that can pay off for years to come. I'm curious to hear how this is changing your perspective. Now that you have the playbook for a potential rate cut environment, what's the one part of your financial plan you'll be looking at first? Is it your stock allocation, your savings strategy, or are you thinking more seriously about real estate? Let me know in the comments below. Your insights might just help someone else in this community who's navigating the exact same thing. Thanks for watching, and I'll see you for the live stream in a few hours.